Yeah, I would say the market for institutional demand of crypto is hotter than it's ever been. I think ETF flows are going to accelerate. I'm feeling pretty bullish. Everything is an ETF. Yeah, that is exactly right. And so everything's going to be in crypto. We're going to see single assets. We're going to see index-based. We're going to see thematic. We're going to see levered. You're going to see all of it come to market. I think people underestimate the size of the market that something like Ethereum or Solana is going after.
Right.
Matt Hougan notes that institutional interest has never been higher, not just in Bitcoin, but also in stablecoins and tokenization. Traditional finance now has names for these strategies. They call the Bitcoin exposure play the debasement trade. That term signals crypto's maturity in institutional circles. It means Bitcoin has officially been branded as a macro hedge, a digital form of gold that protects against currency debasement and fiscal instability. Matt predicts that ETF inflows will accelerate, not slow down. He points out that in the ETF world, year 2 is usually bigger than year 1, and so on, because major institutions take time to approve new ETFs for client portfolios.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I'm really excited about the broadening of the ETF landscape.
Yeah.
Because crypto tells a much better story when you're talking about all the things it can do than if you're just talking about Bitcoin. And I think that's really changed. I'm exciid about the downstream. I've been thinking a lot about what the second order investments are to the stablecoin boom. I think many people want to invest in stablecoins, and so they buy ETH and Solana and Tron and Circle.
Yeah.
But I think if you have an enormous growth in stablecoins, you're going to see an enormous growth in DeFi. I think there's some interesting second order effects to stablecoin growth that people probably aren't paying attention to yet. So I'm excited about that. But mostly, I don't know. I think it's never been a better time to invest in crypto. So I'm just excited to watch the market grow. And institutions are still just as fired up about Bitcoin, stablecoins, and tokenization. In fact, I'd say they're more fired up. We even have a term for the Bitcoin trade now on TradFi, the debasement trade. So it's been officially branded. That's sort of a stage of maturation. And then there's the stablecoin trade. But yeah, I would say the market for institutional demand of crypto is hotter than it's ever been. I think ETF flows are going to accelerate. I'm feeling pretty bullish. Usually in ETFs, year 2 is bigger than year 1, year 3 is bigger than year 2, year 4 is bigger than year 3. That's for 2 reasons. One, big institutions take a time to okay ETFs. Right. So like in Bitcoin land, Morgan Stanley just said 2 weeks ago that their advisors could buy Bitcoin ETFs. So you have new markets that open up. And the second one, which is just so obvious, is like, what's the first time you bought Bitcoin? Have you bought Bitcoin since then? I bet the answer is yes. I bet you didn't just like one and done.
Yeah.
So even the people who bought Bitcoin ETFs last year are buying them again this year. Yeah, I really think flows are going to accelerate hard into the end of the year. Flows perspective, the one thing I would point out is that there are some blockchains, protocols, assets that occupy a bigger space in people's minds than they do in a market cap perspective. So I'd talk about Solana, for instance. If you look at the coverage at Blockworks, the ratio of coverage between Bitcoin, ETH, and Solana is not that different. But from a market cap perspective, Solana is 1/5 the size of ETH and 1/25 the size of Bitcoin. Why does that matter? It matters because even a little bit of flows into Solana ETPs could significantly lift the market. So that's one thing I would keep in mind. From a market structure perspective, the thing that's happened in Bitcoin, as an example, is ETFs have become effectively a layer 2 for Bitcoin, right? There's a lot of trading and transaction in Bitcoin ETFs that doesn't manifest on chain. You can think of it as almost separating investment transactions from real world transactions. I suspect we're going to see that in these other places. And that's actually robust for the market. We don't necessarily want Solana consumed with investment related activity of SOL tokens. That's great if it happens on ETF land. So I think ETFs are very complementary from that perspective.
it doesn't inhibit the revenue potential or fee profile, you don't think?
Well, it does a little bit, but I don't much care about that because I think people underestimate the size of the market that something like Ethereum or Solana is going after.
Right.
Most crypto investors have a very specific opinion about individual assets, and most TradFi investors, as I said on my panel here, don't know how to pronounce Solana, right? So they are going to be better served with a broad-based basket, an index basket. If you looked at my index, you would find an asset that you hate.
Yeah.
And therefore, you'd be like, I'm not buying that. But if you're a TradFi investor, you don't know, and you just want exposure. And so I think that'll be a dominant way that many people gain. If you're interested in hard assets and you're 100% gold, you're off the market, right? The market is saying it's 90-10. 90-10 would be the base. If you're at zero, if you're 100% gold, 0% Bitcoin, you're effectively short Bitcoin against the benchmark of what the globe is telling you is global stores of value. So I think there's a lot of interest in at least being on benchmark. 60-40 is better than 90-10, but 100-0 is like mathematically wrong. So the way it used to work is you had to go to the SEC and beg.
Right.
And in addition to begging, you had to prove that this ETF was not subject to manipulation, which is sort of proving a negative, which is very hard to do. It took, 10 years in Bitcoin, a few years in ETH, and every single one had to go through this process. What they changed is they moved to what's called generic listing standards. Generic listing standards means if you fit a checkbox, then you can launch your ETF. And so, as you mentioned, if there's a futures contract that's been trading on a regulated exchange, including exchanges like Coinbase or Binomial for 6 months, then you're good to go, right? And that means we're going to get a dozen crypto assets roughly launched now, and then more futures will list, and we'll get, a few dozen. A fun fact from ETF land is this actually happened in ETFs. So believe it or not, when ETFs were first created, you had to petition for every single ETF. And then there was something called the ETF rule, which was put in place, which established this generic listing process. What we saw is that the pace of launches in traditional ETFs rose by about 400%. So 4x.
Now everything's an ETF.
Now everything is an ETF. Yeah, that is exactly right. And so everything's going to be in crypto. We're going to see single assets. We're going to see index-based. We're going to see thematic. We're going to see levered. You're going to see all of it come to market. Yeah. Not all of those will attract attention or flows, but some of them will.
Reflecting on recent volatility events, like the Friday sell-off triggered by geopolitical news, Hougan highlights how crypto passed the stress test. While there were some issues with exchanges and liquidity, the market remained functional. For him, that resilience is proof of crypto's maturity. He also discusses a coming shift in market hours and structure. Today, traditional markets operate 9 to 5, but the future of finance is 27/365, and crypto is leading that charge. Stablecoins will become the backbone of real-time global settlements, connecting systems like SWIFT to blockchain rails. That means in a future world where markets never close, stablecoins aren't just payment tokens, they're infrastructure.
First, it's worth noting from a price perspective, Friday didn't happen to institutions.
Yeah,
right.
yeah.
The market closed at 117 Bitcoin and opened at 115. No big deal. From a excitement perspective, look, I love the perspective that crypto broadly passed the stress test on Friday. I know there were some issues on Binance. I know there were some issues on transactions being fulfilled, but broadly speaking, it passed. So I don't think it dulls excitement. We're also in ETF land. While we're going to get a lot of ETFs, we're not talking about the long tail, right? So, Atom traded to zero. There's no plan for an Atom ETF, right? So I think if anything, it was a pretty good stress test, and I think we passed pretty well. One way to think of ETFs is they let every investor invest like the largest institution in the world, right? That's a really cool thing about ETFs. I can buy the same Bitcoin ETF as Harvard's endowment. I think that's pretty cool. You can package these complex trades and make them available. The risk of it is you have to do a very good job explaining it, right? The number of investors who don't understand that a 3x ETF can go down when the underlying market goes up over the course of a month. It's actually very simple math to explain it, but the number of people who get it is challenging. So you need explanations, but if you can do it, it's fantastic. Like, why should institutions have access to that trade and not me. It doesn't seem right. Bitwise is definitely looking at it.
Yeah.
We think there's a sequence that people get interested in it.
Right.
But I think things like those buffered ETFs and things, if you can explain them well, will eventually be a very big. The risk is, from my perspective of complex ETFs, is that people buy them who don't understand them, and then they blow up, and then they sue the ETF issuers, and they look poorly upon the industry. That's been happening in ETFs for the last 20 years. There was a inverse volatility ETF, XIV, that famously went up.
The oil ones. In the 2020
Oil ones went negative, and the bear, the 3x negative financials ETF returned negative during the financial crisis, which blew people's minds. So that is the big risk. Is there any like reflexive risk into the market? I'm not sure. We're pretty good at levering up in crypto. I don't think ETFs are gonna. I don't think we need ETFs to do more of that.
We always have a bias to forget how early it is.
It's so early. I mean, even people even do that just thinking about stablecoins versus tokenization. But just looking at stablecoins, right? The consensus is the market's going to 10 or 12x in the next 4 years. There's 1.8 quadrillion payments a year. Quadrillion. Like, how many times have you used that word? Never. So the size of that market is just so large that I don't mind if like me trading my SOL or ETH position takes place in ETFs. That's probably good. Yeah, you're definitely seeing it. So you're seeing like markets like CME start to investigate it on S&P 500. I think it's two things colliding. So one, it's the innovation of perps, which I do think is a real financial innovation. And the second thing is you have a retailification of the options market,
Right.
which traditionally was an institutional market, which could handle those large contract volumes, which could handle, various Greeks that didn't need to be WYSIWYG, where what you see is what you get. But now we have retail investors really embracing, and you put those two together, I think you're going to see the perps market become a dominant way that people gain exposure to all assets. It's just a really nice, neat innovation. Yeah.
It's I like the New York market hours for it's good for mental health when you're active in the markets. So hopefully they keep that coming.
I would say enjoy it while you can.
Exactly.
The world wants to be global 24/7, 365. That's where I think we're going to go. I do think it's going to change market structure. One thing I'd note, it's hard not to talk about Friday. One thing I note about Friday is the Trump tweet came out at 5 p.m. That was 8 hours after China. The reason it came out at 5 p.m. is that's when you dump bad news on the market, so the market has time to digest it. But that's no longer going to be the case, right?
The thing now that we're talking about it, that actually just light bulb went off. If you start perpifying all traditional, so S&P 500, all these things, you need banking rails at 6 p.m. on a Friday, and that's stable. Either Swift is on the blockchain, which we saw some announcements, whatever, but that's stablecoin.
That's stable.
You basically need stablecoins for perps.
You do
of S&P, whatever.
You need stablecoins. You need a different structural relationship.
That's actually wow.
I think that's going to happen too. And you do see regulated exchanges looking to permission stablecoins or assets like BITL as collateral, like as official collateral. And the 24/7, 365 market needs all the pieces of crypto to really operate. I mean, look, from one perspective, ETFs and option on ETFs are a bridge to our tokenized future and our decentralized future.
Right.
But that bridge is going to extend for 10 years. So right now, I mean, there's more IBIT options than there are Bitcoin options on Deribit.
Yeah.
Right.
Yeah.
So it's like the old meme about who's the captain of the ship. That is now the ETF TradFi landscape. Yeah. Broadly speaking, it's just good.
Yeah.
Broadly speaking, it's a different set of investors, which should reduce volatility, reduce serial correlation risk. And I think that's generally true. There are exceptions to that. So one exception, one of the reasons I think Friday was as big as it was is that traditional investors now use Bitcoin to react to markets.
Yeah.
Traditional markets are closed. That wasn't true 2 years ago. Mm-hmm. And now I think everyone reaches for that Bitcoin button. So that's an example of like the negative externalities. Mm-hmm. But broadly speaking, it's a net good. Yeah.
Yeah. I enjoy the safety infrastructure, integrity of traditional brokers. I think, crypto space has graduated, but still, I think most people prefer custody in existing players, and also the liquidity and things of IBIT options. But what's the timing, do you think, towards like that? The 24/7 is the biggest, but traditional guys don't care, I guess. But it is that's a downside.
Yeah. So there are two forces to keep in mind. One is when regulation unleashes real 24/7 markets in a tokenized fashion in a way that most of the money cares about.
Right.
So I would guess that that's like a 3 to 5 year thing. I don't think it's tomorrow. And the second is, when do young crypto native people have money? Because every generation gets its version of a broker. There's the Charles Schwab generation, and then there was the E-Trade generation, and now there's the Robinhood generation. And you can see that Robinhood now really matters because the people who grew up with Robinhood now have actual wealth. I think the thing behind Robinhood is sort of a crypto native generation. I think that'll be the first generation that makes tokenized stocks. But those people, it'll take them 10 years to have real money. So I think it's coming, and there are probably these two phases. But it's not tomorrow. I'm very excited about it, but it's not tomorrow.
Hougan closes with a long-term view that zooms out beyond current ETF trends. He argues that the next great wave of financial innovation will come from crypto-native generations. Just as previous generations had Schwab, E-Trade, and Robinhood, this new generation will build tokenized markets, trading stocks, bonds, and real assets directly on-chain. But these investors are still young. It will take another 5 to 10 years for them to accumulate meaningful capital and reshape finance in their image. For now, ETFs will serve as the on-ramp, the mechanism that allows trillions of dollars from legacy systems to enter the crypto world safely.